everyone, welcome back. I'm Christina Steeren with Bullseye Investments, where we help busy professionals invest in their futures when time is scarce. Yesterday, you figured out how long you were comfortable leaving your initial investment in a single opportunity based on your investing goals, which means you might have a couple of different time lengths depending on what your goals are, and that's totally okay. Today, we're going to dive into a topic a little bit more complicated, but do not worry. We're going to make this as easy and simple as possible for you to think about so that when it comes time, you'll be able to invest with confidence. Our topic today is, where do you want to invest? Now, there are so many different physical locations and types of investments that you can put your money into that this is kind of an overwhelming topic when you first think about it. So today is going to be more of a guide to figure out what is most important to you when looking at an investment so that you have that confidence when you're looking at those new investments that you know what your core values and what you like best are without necessarily pigeonholing you into one type of investment in one single market. There are so many different areas that you are capable of investing in when you start looking into multifamily syndications. And everyone's process is a little bit different depending on their needs, their wants, and their preferences. So we're going to talk about 3 overarching areas that you should consider when you're determining what characteristics of a location are most important to you. The first one, of course, that most investors think about is, a physical location, either a city or a state, somewhere that they physically can look to invest their money. Now, within this category, you have people who are interested in looking locally or into markets that they're familiar with, that they might live near or have lived in or perhaps vacation in. And then you have other investors who like to look outside of their local markets. And the benefits of both are a little bit different. When you're investing in a local market, you are relying on your knowledge of that area and your comfort with that area. A lot of times, if it's a very, very local market, it's somewhere that you can actually drive to and drive around and be like, okay, I feel like I really know this area, and that's why I'm comfortable with it. Some people, on the other hand, like to look outside of their local market because they want to take emotion out of it. They don't want to be tied emotionally to an area. They want to be really flexible in their portfolio, and they really want to hire or to engage the very, very best team. They want to build a really strong, solid team that they know can take care of their investment money and give them the best returns. So they might look outside of their local market for that reason. I'm going to link an article below with a little bit more about investing outside of your local market and why that might be something that you might be interested in. Now, the second overarching area that a lot of investors consider is not necessarily a specific location like a state or a city, but more of an overarching geographical area. So some investors know that they don't want to have to deal with investments that are in places that get very cold, for example, or where there's a significant amount of snowfall, because they are aware that there are costs associated with areas where there is a significant amount of snowfall, that there might not be associated with areas where there's not. They may not want to be near a coastal community, right? They don't want to invest near the coast where, say, the instance of hurricanes might be high. So that's something else to consider. Maybe you're not tied to a specific city or a specific state, but you are interested in being in a specific geographical area because of whatever makes that area appealing, for example. Now, the third area to consider is that some investors aren't tied to a specific location or a geographic area, but they're most interested in a certain type of multifamily investment. So they're actually looking at what in the industry is termed A, B, C units. and looking at a specific type. So an A class unit would be your new builds or very well-maintained newer apartment complexes. A B class unit is going to be older but still well maintained, and then a C class unit is going to be older and not as well maintained. They're looking for specific things within those investments, either the security they feel that comes with a class A investment or the appreciation that you might be able to get with a class B or a class C investment. Now, we here at Bullseye Investments, we love class B apartment complexes. They're older, but not super, super old. And we're able to do renovations and make them basically the ugliest complex on the block. Take the ugliest complex on the block and turn it into the nicest complex on the block, right? So we're increasing the appreciation or the value of the property itself by doing all of these upgrades. Now, that being said, a Class C opportunity at the right price can also yield huge appreciation and really good rent increases if, like I said, it's purchased at the right price and the right renovations and upgrades are done to it. Now, even though those are the three overarching questions that I'm asking you to think about, understand that not every investor looks at things the same way. They might be open to a variety of classes or types of apartments. They might be interested in a variety of cities, states, and even geographical regions. That there are other things that they consider, such as the size of the population in the area they're investing in. They want a certain size population, or they want a certain variety in the industries that employ their residents, so that, say, something terrible happens in one industry, they're not completely shut down in that investment because there are other industries that help balance it. And some are really interested in population growth and making sure that they're investing in areas where growth is going to continue to occur or is projected to continue to occur. Your job today is to figure out which of those is most important to you, so that when you're looking at opportunities, you can really quickly assess, okay, this definitely doesn't meet my criteria. So I'm not going to spend time looking at this because I know this is not going to be a go for me. Or, hey, this looks like it might be something I want to dive deeper into and make sure that it could be the perfect investment for me. So go ahead, figure out what works best for you, add that onto your blueprint for today, and tomorrow we're going to be talking about what could possibly be the biggest question of all. Who do you want to invest with? And the things to consider when answering that question. We'll see you tomorrow. Have a great day. Bye.